How many of you watching this use chart patterns like this? You wait for a head and shoulders, you wait for a double top, double bottom, or you wait for a pennant or a wedge breakout for you to buy or sell. Now, these patterns alone can be very misleading, but in this video, I want to explain a tool that you can use to help put the probabilities more in your favor, that you take better setups that offer better risk to reward ratios. How many times have you taken a pattern such as a falling wedge or a rising wedge, you enter the market long or short, and directly after you enter that position, the market reverses, you stop out, and then eventually it does move in your favor, and you taking a loss could have been a win if you kept holding. Now, for me personally, as a short-term trader, these patterns by themselves are very misleading, and for me, they have to be confirmed with some type of volume confirmation. Now, I have a philosophy in the market of simply spotting non-obvious things before they become obvious. If they're very obvious, that means everybody is watching it, and the edge becomes less likely to occur if everybody is doing the same thing. My 85-year-old grandmother can read a technical analysis book and draw a bullish pennant, pull up a random stock, draw this pattern, and buy and sell just because of a bullish pennant appearing. It's very obvious and everybody could do it. Now, if everybody is doing the same thing at the same time, that means it's obvious, the crowd is there, and the reliability of it becomes slimmer. So my philosophy is spotting non-obvious things before they become obvious. And I want to confirm these chart patterns with how participants are perceiving price. If everybody is entering or longing a breakout of, let's just say, above this bullish pennant, or they are shorting the breakdown below this descending triangle, then I want to gauge how participants are perceiving these prices, and we can spot this with the order flow. So let's go for a trade example on the S&P 500, and here we could see the market had a nice little rally up, and then we got a consolidation phase of lower highs. We could see a high that formed here. We could see the second high that formed there, drawing a downtrend line. And also the market was putting in a lower low. So lower highs and lower lows represented by this lower downtrend line. So the general rule of this falling wedge pattern is getting in and entering as soon as it breaks out and breaks this lower low and lower high pattern, as we could see here by this falling wedge. So by theory, we would enter the market long when it breaks out, placing our stop loss under the low, targeting a breakout to the upside. Now, using this theory and using this falling wedge chart pattern alone in its entirety, again, would be misleading, because if we are in the market long on the breakout, we're going to see a sharp pullback lower, and eventually the market sells off and stops us out using this chart pattern by itself. We could see a clear breakout and a clear dump down, resulting in a losing trade by itself. However, if we were to confirm this breakout long to the upside, using some sort of order flow or volume confirmation would be more leading and would put the cherry on top to this chart pattern. Now, what you're going to notice here is as the market breaks out, the breakout started to occur around 11:55 Eastern Time, and the dump eventually happened and ended by 12:40 Eastern Time. So about an hour's worth of a breakout that failed and resulted in a sell-off to the downside. Now, pulling up a time in sales here, we're going to notice is as the market breaks out at 49.27, at 49.25, at 49.21, as it was breaking out to the upside, 49.30, we're going to see massive size, meaning massive sell orders come into the market as this thing is breaking out. So as it's breaking out, you're seeing a lot of selling activity stepping into the market. So if we were looking to take a long, seeing all this aggressive selling hitting the market, number one would be a red flag for us to not buy this breakout. And number two, this could be a good indication that says, hey, Carmine, let's maybe take the market short here, because we know a lot of people are going to be longing the breakout because it's such an obvious falling wedge pattern that I know a lot of people are going to be liquidity, longing or buying this breakout, not realizing there is a ton of selling activity entering the market, that this could be a good indication the market will sell off by reading this volume pattern. And using a tool such as a heat map, this is why I love using a heat map, because we can see why the candles are forming or how they are forming with how the volume is affecting price. So here on the heat map, we could see the same downtrend line. Lower high, now attempting to break out, lower low 1, lower low 2, and as the market breaks out, we can see the same exact thing here on the candlestick chart. Looks exactly identical to this. Now watch what happens when the market breaks out. What you're going to see here is as it's breaking out above this line, number one, we see a passive seller sitting there at 49.30. This is not something that you're going to be able to spot from a candlestick chart. You're not going to know if there's a seller or a buyer alone off of the candlestick chart. The market's going to break out above this passive seller. And how do I know it's a passive seller? Well, we could see a larger red line there indicating there is more thick passive wall of sellers sitting there, that as the market breaks out, it eventually gets filled. And what you're going to notice here is there's going to be a ton of buying activity, but no reward. When you see a lot of buying entering the market, aka strong aggressive buying, you can see larger green bubbles here, but the market is not moving up. That means there is a passive seller passively selling and absorbing all the aggressive buying. All here, 49.30. A lot of people would see this and say, okay, I'm longing this breakout right here. It just broke out. There's tons of green buying over here. Well, guess what? It's not moving up, indicating there's a seller present in the market. Now, fast forwarding this even more, the market's going to break out and try to move up even higher. Does not get it. Watch how it develops. Aggressive selling steps in, traps all those buyers who got long there, and this thing dumps and aggressively sells off much lower. And you could see a ton of buying, but no follow through, indicating there's a seller there. So for every transaction, there's a buyer and a seller. If a buyer enters the market with large size and the market doesn't move up, that means there's a seller absorbing all that buying activity. And that's a good indication the market went reverse. Also validating my point of being liquidity, that people are buying this breakout, their longs, or they're buying those contracts to somebody who is selling it, someone who's passively there, acting like a wall for this thing to dump. And that's how you could capitalize on a sell-off to the downside, understanding that people are buying this, or if you're looking to buy this, to not buy it because the volume is not confirming that at all. It is very simple to draw a chart pattern like that on your charts and buy it or sell it as soon as it breaks. Again, if my 85-year-old grandma could do it, the reliability of it becomes a lot slimmer. Start doing non-obvious things before they become obvious. I have been faked out many times buying or selling off of a chart pattern alone. When I used the volume to confirm the pattern, my odds became more successful and it helped me avoid trades that I should not be taking. If the volume is not good enough to confirm that setup, then I simply do not have to take that trade. It also has put me on the correct side of the market by selling when other people are buying or buying when others are selling. I love buying when others are selling, and I love selling when others are buying. Because when others are buying and they're not getting any reward to their trade, if the market reverses on them, there will be a lot of pain. When they are in pain, that's when there will be the greatest gain for me. So here we can see a solid little uptrend line that I marked at a previous high. It also has rejected for the second time. The second time it was tested, validated this was a valid trend line. Now recently, as I'm recording this, in the middle of February, the market, the S&P 500 specifically, was making all-time highs. When the market is making all-time highs, it is very difficult to resist prices as it moves higher, meaning we have no resistance at all-time highs. Neither does the market have any supply at all-time highs. So doing something like this, where you mark a high and the second time it was tested was rejected, you project that line forward, could give you further resistance as the market is discovering new prices. Now, on this day of February 12th, the market rejects this upper trend line. And I'm going to show you all how to use this as confirmation that you could capitalize on either selling longs there or capitalizing on a reversal and taking the market short, capitalizing on a downside sell-off lower. So here what you're going to notice is the market opens up and we get a very strong rally up into our black line, which was that upper trend line resistance. Now, at this moment, when the market looks very euphoric, a lot of people, number one, will be chasing this. And number two, a lot of people will be providing liquidity with their chase for someone who is selling or looking to offload, or someone who is looking to open up a new sell or short position at these prices. So when everything looks obvious that this thing is breaking out, this thing is very strong, have a red flag that goes off in your head, especially with this thing being at the upper trend line resistance, that hey, this may be a good opportunity to go against the crowd. Again, it's also spotting non-obvious things before they become obvious. It's very obvious in this instance that the market looks like it's going to break out and keep going up forever. Oh, this thing is going to the moon. However, if you were to use some type of order flow to confirm this, this would have been a solid opportunity to take the market short. So here is our rally. You can see as the market's moving up with the green bubbles, then we come into 50.66, which was the high 50.66 over here. So as we come into this high and everything looks euphoric, look what happens as we come into the upper trend line. Everything was green. Everything was aggressive hitting the offer. And as soon as we come into these 66s, even these 62s, red aggressive selling then steps into the market, something we did not see earlier. But it's as soon as we come into this upper trend line and as everything becomes euphoric and everybody is buying, now look how the tides change and selling starts coming into the market. The market eventually gets a dump down lower, and then we rally back up. Again, using the order flow. You can see these orange lines up here. What that tells me is there is a passive seller entering the market. As the market comes back up later in the afternoon, an hour after it sells off, this is 12:15 Eastern, 1:15 Eastern, the market rallies up into this wall of orange sellers, passive sellers. Zooming in, you can see large buying activity, trying to buy from a passive seller. If the supply exceeds the demand, meaning there is more passive selling than aggressive buying, the market only has one option to move lower. We can see large green bubbles here, passive seller gets filled, and then aggressive selling by these red bubbles steps in thereafter, capitalizing on a very large sell-off to the downside confirmed with the order flow. So using the order flow will help confirm these chart patterns. Using these chart patterns in themselves will work, but it's all about putting yourself in the position where the odds are most in your favor. When you use this order flow in this manner, you put yourself in the position to be on the correct side of the market when the probabilities are in your favor using the volume confirmation. Essentially, you are avoiding the crowd by not doing what 95% of other traders are doing. And you're doing what the larger participants who actually move the market are doing. So if you take any of my advice, is chart patterns are good. I use them all myself. You know, double tops, double bottoms, head and shoulders, they are all valid. However, once you use the order flow to confirm that pattern, that's when the odds become increased. This is what I do. I don't use chart patterns. I stopped using them entirely by themselves, and I started to implement volume patterns around the chart patterns, and there was a major difference in my trading when I implemented this. If you got any value out of this, I would appreciate it if you could subscribe to my channel, drop a like on this video, and comment any questions. Peace out.